The potential second wave of inflation, a look at the playbook. In recent times, there has been growing concern about a potential second wave of inflation, drawing parallels to the inflationary period of the 1970s. In the next few minutes, we will explore the patterns and factors that could contribute to this upcoming wave of inflation. It delves into the events of 2020, the actions taken by the Federal Reserve, the impact of government debt, and the potential consequences for the economy. Additionally, it highlights the current state of asset prices and the opportunities they present for investors. The money printing and asset price surge. Money printing that started in March 2020 has coincided with a surge in asset prices. However, the prices of goods and services did not rise significantly until March 2021, and they reached historic highs in June 2022. Concerned about runaway inflation, the Federal Reserve began tightening its policies by reducing its balance sheet and raising interest rates. As a result, the rate of inflation started to fall. Government debt and inflation. During this cycle, the entity with the most debt, in this case, the U.S. federal government, faces the most pressure. The government borrowed trillions of dollars at historically low interest rates to stimulate the economy. However, as inflation persists and interest rates remain high, the government is struggling to roll over its debt at affordable prices. This situation could lead to default or reliance on the Federal Reserve to ease the burden. Debt monetization and inflation. The Federal Reserve will likely resort to debt monetization, also known as quantitative easing, to assist the government. This involves printing money to lend to the government, resulting in an increase in the Federal Reserve's balance sheet. The government can then continue borrowing, injecting new cash into the economy, and potentially driving inflation higher. This pattern mirrors the inflationary period of the 1970s for slightly different reasons. Anticipating inflation through asset prices. Asset prices, such as gold, silver, Bitcoin, and stock market indices, are already reflecting the anticipation of future inflation. This phenomenon, known as the Cannon effect, presents opportunities for investors to profit from asymmetric trades. The gold miner ETFs have already yielded significant gains. To make sure you stay connected and learn more about various trading strategies, be sure to subscribe. Job growth and the wage price spiral. There is a special relationship between job growth and inflation, specifically the wage price spiral. Even without new money entering the system, job growth can contribute to rising wages and spending, potentially fueling inflation. The recent jobs report indicates growth primarily in government jobs, which are a drain on real wealth. This situation exacerbates the wage price spiral without a corresponding increase in economic growth. The Federal Reserve's rate cut expectations. Contrary to market expectations, the Federal Reserve is unlikely to cut rates as anticipated. Statements from Federal Reserve officials have indicated that they will wait for inflation to move lower before considering rate cuts. The Federal Reserve is wary of repeating the mistakes of the 1970s when rate cuts reignited inflation. Instead, the Federal Reserve will likely refuel inflation through debt monetization. Conclusion. The potential second wave of inflation has drawn parallels to the inflationary period of the 1970s. The actions taken by the Federal Reserve, the impact of government debt, and the anticipation of inflation can be seen in asset prices. We also want to emphasize the role of job growth in contributing to the wage price spiral and the Federal Reserve's reluctance to cut rates. Overall, it suggests that inflationary pressures are building, and investors should be prepared for potential market shifts.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.